Now, Deutsche Bank, Germany's largest lender, has seen its shares fall as much as 15% over 3 consecutive days of losses. Joining me now, Sky News' business editor and host of Business Now, which is on right before my program at 4:30, Ross Greenwood. Ross, thanks so much. Good to see you. Now, what is happening here? Do you think Deutsche Bank is, because it has made moves today to try and, stop this influx, this turmoil, do you think it's going to be able to avoid needing some extra guarantee or takeover?
I think it pretty much will, and it has. The German Chancellor came out in support of it. So did the head of the European Central Bank, Christine Lagarde. And really almost, just to explain this to people, is it's almost like a game of whack-a-mole that you'd see at the local fair. In other words, one pops up, you hit it on the head, and another one pops up somewhere else. And that's pretty much what's being played out right now. But the central banks who have got to fight against inflation, in other words, have been causing this by raising interest rates. And that means many of the investments that they held and bought when interest rates were very low are now worth a whole bunch less money. And that could be even mortgages against commercial property. It could be bonds that they're holding. It could be even government bonds that they've got as the ultimate security. And so what's happening is it seems that the central banks are quite prepared now to effectively prop up and save these banks, as they've done with SVB, Silicon Valley Bank, with Signature Bank, with Credit Suisse, which was forced to merge with UBS, and now also with Deutsche Bank, which ostensibly doesn't have any real problems, but quite clearly the guessing game now is who has the problems, who has these investments which are now underwater. That's the reason why Deutsche Bank shares fell 8.5% on Friday, although I can tell you the futures markets, and it's about to start trading, the German stock market looks as though it's about 0.5% up, so it looks as though there is some relief in sight after Friday's scare.
Ross, I mean, it's fascinating because you've got analysts and economists are saying that the market's on edge and it seems to be looking for where the next target is. Social media played a big role, or you can debate that, but it played a role in the Silicon Valley collapse. And again, there's been a lot of activity around Deutsche Bank. Do you think this sort of speculation on social media is really playing into what you describe as the game of whack-a-mole? You know, which financial institution is going to come under pressure next?
There's no doubt. And part of the reason for that is the way in which we all bank these days. And that is, if you think about Silicon Valley Bank, as soon as word got out that something was amiss, that something wasn't quite right inside that bank, and strangely enough, it's not that its credit was bad, effectively. That's what normally sends banks down, is that they got bad loans. In this case, it wasn't that. It was the mismatch of securities. The bonds that they'd bought when interest rates were very low suddenly became worth a whole bunch less money. But the way in which we bank these days is through the internet. And so as soon as the rumour gets out, people could move their money almost instantly somewhere else where they thought it was safer. And as a result, the run on the bank doesn't actually lead to queues of people running down the block these days. It's actually people just moving their money instantly. And that is a new risk in banking that wasn't there even 10 or 15 years ago.
Yeah. A new risk to an old problem. I mean, we saw it in Mary Poppins movie, the old school bank run.
Exactly.
Now, I want to ask you about the volatility in the market. In your view, Ross, is this the end of volatility? Is this the end of a banking crisis, or could we just be looking at the beginning of one?
I think it's really the beginning of one, because remember that point that I made there is that good old-fashioned banking crises are about bad debts. It's about businesses going broke, and therefore, as a result, the banks take the consequences. Now, banks here in Australia are much safer as a result of the Royal Commission and also the financial system inquiry going back about 10 years. But do remember one thing, and that is interest rates going up leads to bad debts ultimately. That's it. And that's the narrow path that central banks here in Europe and the United States are having to navigate. So while we've seen the first part of it, the mismatching of the assets, what we haven't seen is the credit crisis that comes from rising interest rates. We may not see that for another 12 or 18 months, but if interest rates stay as high as they are in this quest to defeat inflation, ultimately at some point those bad and doubtful debts will inevitably rise and credit quality will become the key for all lending institutions around the world.
Yeah. Now, I mean, Ross, I know in the past you've defended very strongly on my program the RBA Governor, Philip Lowe. And look, he wasn't the only one to do it. Central banks globally did kind of give assurances that interest rates weren't going to go up for several years. This is, you know, back in 2019, they said we'd probably be safe until 2024. But again, this is just another area where their misleading advice has caused problems.
Well, I was going to say, Sharri, about that. I only defended him on his cheap loan that was historic. I haven't defended him on his policies, which I think the bank has got wrong. And I think over a series of time, there have been missteps by the Reserve Bank. Now, to be honest, they too, like the other central banks, are navigating this narrow path right now. And some of the word coming out is OK. But the one thing about them is, remember, the review into the Reserve Bank is handed to Jim Chalmers on Friday this week, which could see a significant change in policy about what they target and indeed the way in which interest rates are set and by whom they're set in the future. You could even see ACTU representatives on the Reserve Bank board into the future under this current government as well. Wow,
yeah. Well, I've heard Sally McManus is one figure who would like to be appointed to the RBA board, and we know that there are several figures whose terms are coming up. Now, do you expect the recommendations as part of this RBA review to be quite drastic, and do you think that the government, the Albanese government and Jim Chalmers would be prepared to take on some of these moves? I mean, when I spoke to Jim Chalmers on this show, when I interviewed him, he said he was looking for more accountability from the RBA board and the governor out of this review. But, I mean, surely they wouldn't take away the power of raising interest rates from the RBA. It would just be a matter of putting more transparency and accountability in there. I mean, no government would actually want to be responsible for raising rates. They'd never do it. They'd never get elected.
Well, do you know something? That's the problem. If you don't have an independent Reserve Bank, central bank, then guess what? Politicians would do the politically expedient thing.
Exactly.
And they would therefore, as a result, not do the economically correct thing for Australia. That's the reason why you need an independent Reserve Bank. That is one thing I would defend every day of the week.
Yes.
But what you also want is a Reserve Bank board that has got a good, strong culture internally that actually does embrace criticism if they have done the wrong thing, that embraces openness. Therefore, there are press conferences every time a monetary policy decision is made, because that embraces it, that does embrace the debate that goes inside that Reserve Bank board when they make decisions. These are things that the Reserve Bank board has failed to do over a period of time to change its culture, and this is something that I think will come out of this review into the Reserve Bank. And certainly whether Philip Lowe survives beyond September, I don't think he does. I think Jim Chalmers will replace him, but they've got to find the right person who is prepared to embrace the sunlight that needs to come into the Reserve Bank and the way it sets interest rates.
Who do you think it should be?
Well, it'd be interesting to see if Caroline Wilkins, who is the head of this particular review into the Reserve Bank, who was former Reserve Bank of Canada, been on the Monetary Policy Committee of the Bank of England, if she was prepared to put her hand up, whether it be Stephen Kenny, the head of the Treasury Secretary in Australia right now, who's on the Reserve Bank board. These would be two immediate candidates that would spring to mind who would clearly embrace a new way of doing things at the Reserve Bank.
All right, well, that review is going to be genuinely very exciting. I can't wait to see what it recommends on Friday.